Alright, what's going on, guys? I just wanted to do another video, kind of elaborating on what we talked about yesterday, which was the supply and demand aspect of the stock market. And I want to show you guys a couple of charts. I know we went through the demand part where you have stock, it shoots way up, the volume increases, the demand increases, and you get that big spiking pattern, right? Like IGC. You see, demand opens up here, stock starts to increase. The more the demand, bam, the higher it goes. Now, let's go to another company. So, HMNY is famous for increasing the supply of stock. And that's why we have this chart pattern where it's literally just going down. It's going straight down. Another one is MNGA. Right? So over 2 years, the stock is literally just going down and down and down and down and down. And you guys wonder why I call it trash. And that's because in business, when the companies don't have cash, you need cash to run, right? So think of cash as like the blood to your body. If you don't have any blood, you're gonna die. If your business has no cash and it has no cash flow, your business is going to die because you can't operate, you can't run, you can't live on no cash. So a lot of these companies, right, that people message me about, like, oh, should I buy this or why is MNGA trash? Well, it's trash because they're not making any money. If we take a look into the fundamentals, this company is losing uh $11 million a year, $17 million, $9 million. So this company is losing tons of money. That money isn't just, it doesn't just come out of nowhere. It's you guys by buying the shares, you're giving the company money because what they do is to get cash, they don't sell their product, they don't do anything with their product. To get cash, they sell shares, they sell ownership of their business in exchange for cash to keep this business alive. Okay? And, oh, okay, I'll give them some cash so they can keep their business alive. But the thing is a lot of these companies, they're not even trying. They're not even trying to turn a profit. They're going through the motions, doing whatever, or their business model is just that bad that they can't figure out since 2012, this company can't figure out how to make a dollar. They lose money every single quarter or every single year. And what happens is the insiders running this company, they get a nice paycheck every year, so they don't really care that no matter what happens, as long as they can raise some money by selling shares, well, they don't really care because they're making a couple $100,000 by running this company that does nothing. And how they do this is, if we go back to this chart, you can see they're selling shares, and then what they'll do is they'll do a reverse stock split. So they'll cut the shares back down to whatever they want. So they'll cut their shares, I don't know, 1 for 10. If you have 100 million shares outstanding and you divide it by 10, the price goes up and the shares of the company goes down, but it's still worth the same amount, right? So let's go into market cap. How do you find how much a company is worth? Well, it's really easy. You find out how many shares the company has, which is what I talked about yesterday in the supply and demand video, right? So this company has 37 million shares. So we take 37.7 times the current price, which is 40 cents, and this company has a market cap of 15.08 million. And you can see that right here. This is updated, right? So to find out the market cap, you find how many shares there are outstanding of the company. You multiply that number by the price, the last price traded of the company, and then you have a rough estimate of the value of the company, right? So if you could do that for any company. Now, if you do a reverse stock split, you would divide this by 10, right? Divide the shares outstanding by 10. So now we have what, 3.7 million shares, but we also have 3.7 million times the stock is now trading for $4 a share, right? So you have roughly the same amount. The market cap won't change, but the supply of stock will change. So all they have to do is they can either do two things. They can try to pump the stock up, right? Like this big spike here, pump it up, sell the shares down, create demand, increase supply so you don't destroy your company's value. Or they could just pull the HMNY and just sell the stock as quickly as possible so they don't go bankrupt. Um, you're not going to be able to see it in this chart, but basically they just sell stock because they have to get the cash so fast because they're losing so much money that they have to do this to stay in business or they're going to default and go bankrupt. Like, okay, you see, they have over 1.3 billion shares. 1.3 billion shares. So you guys understand if this goes to a dollar, right? If you bought it at 2 pennies and it goes to a dollar, that means someone would have to buy a company that's worth $1.3 billion, right? And this company is losing $150 million a year. They're losing tons and tons and tons of money. So they didn't lose all of that, but they're losing, a couple $1 million a year. This company's so screwed that they have no shot. So that's basically how the supply side of things change. And now you also have examples like Apple, where Apple's such a good company that they have so much cash extra because they make so much money. They're so cash flow positive that they are just accumulating this massive cash position. So what they start to do is they issue dividends, right? Okay, and people like to invest in dividend stocks. But Apple is also buying shares back. They're taking the amount of shares that they have outstanding and they're buying them back and they're basically canceling them out. Okay? And companies that have, you know, you can do this for a couple reasons. You have excess cash and there's not many other places to invest that cash, right? So you buy back the shares, you invest in your own business, and you bring back shareholder value. Another reason is to maybe you want to take your company private or something, so you accumulate as many shares as possible by buying back them on the open market, and then later down the road you can decide. Another stock I want to touch on about doing this is Tesla, right? And this is the big deal with Tesla. Tesla's not a profitable company. They're not making money. What they're doing is they're using investors' money to drive revenue growth, and in return, they're losing tons and tons of money every single year. They're burning through tons and tons and tons of cash, right? And the interesting thing is why is Tesla able to do this? Because their brand is so powerful and so strong that they've been able to use investors' money to, dish out these cars. Not only have they been issuing stock to pay for it, but the stock has been going up, right? This thing is trading, they're issuing, they're increasing the supply, but the demand is increasing because the stock is going up. And this is what the issue is with Tesla. If they don't find a way to continue this model that they're doing, they don't have that investor support where people are paying paying for the company to operate, well, they can't live off burning through so much cash, all the cash that they're burning, and this is why Tesla could go bankrupt. Okay? This isn't a sustainable business model. You can't just print cash, print cash, print cash, and basically your money's going to run out sooner or later. So basically, those are the different supply factors that go into stocks, and that's something you need to be careful of because if a company is stripped on cash, that means that they are going to be printing stock, right? They're going to be issuing stock in return for cash, for money to keep their businesses running. Okay. Uh, and the really bad businesses like HMNY, MNGA, that's why they're trash because they don't make money, they lose money, and they don't even care. They just, what they're doing at this point is they're just printing, issuing stock, taking the investors' money and running their business and staying alive off the investors' money. But there's going to come a point in time where investors stop wanting to lose their money and they completely just cut out the company from the picture, and that's when the company will go bankrupt or go get delisted off the Nasdaq. And that's why I say stay away from these companies. They're very dangerous. They're going to sell the shares, they're going to drive the price down so they can stay alive. They don't care about you, they don't care if you're going to make money or not. They're just using you for them to stay alive. Okay. All right, so that's the quick little supply lesson on how companies can change their supply of stock.